Okay, we will start the broadcast right now. Oh. Lee. 有一点 share 不到 video. All right, just give me a minute. Can't be able to share the video. Are you seeing my screen?
Yes.
Let me try to play. I'm not sure if you can hear my video or not.
Yes. Can hear, but not very loud.
Attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research. Financial information at my fingertips. Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Good evening, everybody. How are you guys doing today? This is the last day of the month, so hope you guys are doing all right. Okay, at the end of the first half 2021. So welcome everybody to this session, which is using economy indicators to time the market. So today we'll be talking about this very interesting topic because not many people are able to cover this topic. Just hang on, yeah. Okay, apologies. Just now there were echo from the YouTube source that is played from my computer, so I have to off it. So all right, so yeah, this session is very interesting because not many people cover this economic indicators and in particular how to use it to time the market. I'm also interested to learn from our speaker today. How can we use economic indicator to time the market? As you know, timing the market is also not an easy job. And then today we're going to learn how we can use these economic indicators such as GDP, unemployment rate, inflation rate, to see how we can use it to better position our entry and exit. All right. So disclaimer as usual, whatever we share on this webinar is only for educational purpose. So in no way that I give any recommendation to buy or sell any companies should we cover it in this webinar. So if you decide to make any investment decisions, you do it at your own risk. All right. So allow me to briefly introduce our speaker today, and very rare occasion that we got a female speaker come to our show, and we are very lucky to have her coming to our show today. So she's none other than Pauline Young. Pauline is a licensed and experienced financial planner who is certified by the Malaysian Securities Commission Financial Planner Representative License and Bank Negara Financial Advisor Representative License. Pauline is also a course trainer and public speaker at Financial Planning Association Malaysia and Bursa Malaysia. Now, over 25 years in education, she has accumulated over 3,000 students and conducted over 200 large-scale corporate courses. So other than being a professional financial planner and educator, Pauline is also a best-selling author who has published 6 books on investment and financial planning. Now, if you often go to the bookstore, you will find that her books is on the shelf. So her articles have appeared in financial magazines such as The Personal Money, Money Compass, and many more. So, Pauline, how are you today? You muted yourself.
Hi, good evening. Thank you, Shane. Good
Yeah,
evening,
all right.
everyone. Yes.
So let me hand over the session to you.
Okay, sure. All right, thank you. Okay, good evening, everyone. Okay, so today's topic, I see a lot of participants here. Good evening. Okay, I see a lot of participants today, and then particularly there's some in this kind of a market, and then when we are, in such a environment, and then you got the come to this workshop and hope to get some information, right? Okay, so I'll be sharing with you information, and particularly we are looking at the environment now. So if you are looking at the environment, definitely it is challenging. And when we do investing, definitely the current environment you need to understand. And then particularly, we want to see things in a macro perspective. So economic data can allow us to see things from a macro perspective. So particularly for this session, I will introduce market using the economic indicators to time the market. So we will look at the overall history of our GDP for the past 50 years, and then so that you can see where we are now, and also at the same time to introduce to you some of the economic indicators that are usually very sensitive to the stock market. Okay, so let me enlarge my screen. Okay, so the agenda will be explaining the relevant economic indicators that are relevant to the stock market. There are thousands of economic indicators out there. So we will choose certain indicators that are more relevant to the stock market. And then towards the end of it, we apply the moving average line onto the economic indicators and to demonstrate the results. So in this session here, I will share with you my Excel worksheet, and then such that you can do this on yourself at home as well. And then lastly, to talk about the case study for our historical data for our KLCI. Okay, so hopefully all of you will find this session useful. Okay, so in terms of the economic data, they are actually, you have 3 types. You have the leading, lagging, and coincident. So the difference is that when you see the word leading, it means that the information will bring you to see what is going to happen in the future. So that is leading. So these leading indicators is particularly important for the stock market, because the stock market, in fact, the whole thing itself is a leading indicator of the economy. So what the market participant is actually, the way they behave is actually in anticipation of what is going to happen in the future for the economy. So that is leading indicator. And for lagging indicators will be some of the statistics or data whereby the figures were a bit late. When it published, it was already like 3 months later, 2 months later. So so these are the lagging indicators. And also the coincident indicators will be those indicators that are more or less happening in the real time. Okay, so for example, a weekly or a monthly are considered as a coincident indicator that will tell you what is happening now. So let's see. So let's talk about the leading indicators first. The very first thing that I want to talk about is actually this weekly job data. Okay, and this one is actually published from the US. And very often, we don't just look at the indicator for Malaysia, we will look into the US, particularly the US as well, because what is happening in the US market will definitely affect us, okay? And so let me show you where do we get all those economic data. So I will share with you certain website whereby these are the places whereby I'll do my research. So the first one is called Trading Economics. So this one, let me copy and then I put it in the chat here. Okay, so that you can have this link as well. Okay, so this is the tradingeconomic.com. And over here, I'm looking at the US non-farm payrolls. Now, for this US non-farm payroll, it announced on a monthly basis. So it's actually on the first week of Friday, 8:30 a.m. the US time. So for July, the first week is this Friday. So this Friday, 2nd of July, we'll be waiting for the non-farm payrolls. Now, a lot of traders, especially Forex and those traders, they are particularly very much interested in the job data for the US. And this non-farm payroll is one of them. So what does non-farm payroll mean? The word non-farm means that it is not concerning with the farm, agriculture, because agriculture is rather cyclical. So then this will be any other job that is concerning with the agriculture. So you are looking at the number of jobs being added. Okay, the number of jobs being added. So of course, this number you want to be the higher the better. And particularly you want to look at the expected figure. So if let's say the actual figure is different from the expected by a lot, then it will cause some surprise, and then that will cause some movement in the stock market, commodity market, forex market. Okay, so these are the way that people are looking at the data. Okay, and definitely you are looking for a job. So if let's say you're looking for employment indicate the economic activity. So if let's say there are more jobs added to the economy, it means the firms are hiring and it means the economy is expanding. Okay, so that is for the US market. And if you to look at Malaysia, okay, so Malaysia, we do have our unemployment rate. Our unemployment rate is every month on a monthly basis. Okay, so let me show you our unemployment rate. Okay, so this is a construction output. Construction output is also one of the leading indicator whereby you're looking at how much of a construction that we have. So you are looking at the building. So during the pandemic, you can see that for the past few months, it has been on the negative side. So if we look at the 10-year time, so these were the time whereby we had a property market boom, 2013 and 2014. So these were the time whereby there was a shot up in terms of the construction over here, construction output in Malaysia. And after that, then you can see that this actually declined and it come into a negative territory. So that it means that the construction sector is actually contracting. Okay, so that is in an indication showing that our economy is actually contracting. That means it's in a recession. So let me show you the unemployment rate. Over here, this trading economic, this is under the Malaysia. So over here, you can see that we have the calendar. You can click on the calendar and then you can see what will be announcing. There are dates for certain data to be announced. And then you can look at the markets. The markets refer to the stock market, the GDP figure, the label will be the unemployment. Okay, so let's take a look at the unemployment rate. And then as you move on, you can see prices, health, money, trade, government, business, consumer, housing, and taxes. So the housing will be the one that we are looking at, which is the construction output. Okay, so if you want to look at the housing data. So there are so many of it. So we're just going to choose a few that are very, very much related to the stock market, okay? Because there are just too many of these indicators. So the unemployment rate in particular in Malaysia, in the past 20 over years, our unemployment rate, not many economies actually talk about it because we have been maintaining at about 2.7, 3%, 2.7, 3%, this kind of a level for a long time. However, if you to look at last year onwards, we saw this 5.3% in April 2020. And this 5.3, if you look at the number 5, you may think that, oh, 5 may not be a big number, but in our history, 5 is a huge level. That means it's a great unemployment level. And then if you look closer, you see that, oh, okay, we are now looking at the unemployment rate coming down. So that means improving. No, I have to tell you that you have to look at the whole picture. So the whole picture is this thing. So you see our unemployment rate compared to the history, actually we shot up to 5%. Above 5% last year. And then after that, we stay above consistently for one whole year. This is until April. For one whole year, it is above 4.5% of level. So that means we are consistently at a high unemployment rate. And this 4%, if let's say I were to draw one line across, okay, one line across, and then you can see that, in fact, there were not many occurrence that we touches the 4%, and this time was during the subprime US subprime financial crisis, and it touches 4%. And then if you look on the left, another one will be the 1999, 1998, the Asian financial crisis, whereby it was around 4.5. And then, but the unemployment rate quickly came down. Okay, you saw the unemployment rate quickly came down, but this level, it was up and then it was stuck in this level for quite some time. In this case, about a year. I haven't seen it before. Now, if I were to ask you, right now we are in a recession, right? So if I were to ask you, okay, the audience here, you compare this round of a recession, and then you compare to the previous round of a recession, okay? We had a few rounds of a recession. So the last one that you saw was actually 2008, 2009, right? And then you compare another one was 1998. Okay, so those were the major recession. Then if you to rewind back further, in the 1980s, there were also some recession there, okay, in the 1980s. And then, of course, in the 1970s as well. Now, I want you to, although some of you may not be old enough, but then if let's say you are at that certain age, if you can remember what kind of a recession that, you know, like the recession that we are currently experiencing, right? Is it similar than to the 2008? Or is it similar to the 1998? Or is it similar to the 1980s? If you are born old enough lah. Okay, so they said that it's not. Past could be cyclical. Okay, then what do you mean by not? You mean this round? What do you think about this round of a recession? How do you think about this round of a recession? Okay, and then Angeline said that it's 1980s. Ah, okay, good. I would think that because when I was the 1980s, yes, because probably we are about the same age. Okay, Angeline and Azmi, probably we are at around the same age. So when it was the worst recession, when it was during the 80s, I was still very small. I was actually around secondary school level. So I remember that time, okay, during the 80s, I would think that this kind of a recession currently that we are experiencing, right? It's worse than 1998. It's worse than the 2008. It's more similar to the 80s style. Okay. 1986 was the bottom, okay, and there was story behind it. So in the 80s, right, I remember my family, because we were the business owner, we are the SME, the business owner. So if you are in the business sector, right, you feel the recession exceptionally, like you feel it, okay, and then you feel terrible. So that was the 80s when I felt that the recession was kind of like a prolonged kind of a recession, whereby it was not like 1 or 2 years, it was a few years of having some hardship. So that was the feeling, okay, when I was in the 80s. So although I was young, but then I can see that, that kind of a recession is not like a short-term kind of a recession, but more like a prolonged kind of a recession. So this round, somehow I can relate to that kind of a scenario, because I have been to the 1998. That was already, I was in the workforce. I was started out as a research analyst during that time. I was working in the financial industry. So I actually saw the financial crisis and then the stock market and everything. But the kind of a recession in the business sector was not as bad as what we are seeing now. And then the 2008 was even not that, as bad. So what we are seeing now is actually quite severe, okay, in terms of the recession. So, and I can show you the unemployment rate in the 80s. The unemployment rate in the 80s was actually 8%. So you can see that the unemployment rate was above this 4% level in 1983 onwards, all the way to the 1987. So that means there were about 5 years of 4 or 5 years of recession over here. Okay. So although now we are in a 4%, 5% region, so we are still not, we are not there yet, but then, and the situation is totally different. Why? Because during that time, there's no government subsidies at all. We have to survive on our own. There's no helping from anybody, okay? But now look what we have. We have all the government subsidies. How much the government is spending on us for this so many rounds of a stimulus package. If I were to have a rough figure, it's about 500 billion. Okay, so this amount of money is huge and is unprecedented. And if we were to compare to the last round of a stimulus package in 2009, March, when they announced the stimulus package, it was only RM 60 billion. And that's it. It was a quick rebound. In fact, it was a V-shaped recovery. So if you're looking at what we are having here, okay, we have recession, a severe recession, but we have government subsidies. So in fact, we can actually reduce the kind of hardship. Okay, we can try to reduce that kind of hardship. Although we cannot eliminate, but then we can reduce. Okay, so that means what? That means hopefully, and also we are in a low rate of environment, and that is very important. And the interest rate environment is very low now. So low rate of environment. Now, in this low rate of environment, we're looking at OPR at 1.75. Then we have to pray hard that the interest rate will not increase. Okay, I'm going to show you some figure here. Recently, I just saw that our CPI, our inflation rate, suddenly creep up a little bit. And so let's see. I show you the US, and coincidentally, the US core inflation rate also pop up. And you see, this is the US core inflation rate, which is 3.8. So you may think, okay, it's 3.8, it's below 5, so it's nothing. So I show you the maximum here. This 3.8 now, almost 4%, if you to look across, when was the last time that it had reached this level? It was 1992. So that means what? That means this current US inflation rate is a very quick one, okay? Will it lead to this kind of a 70s like of style of hyperinflation? Well, when the reporter asked Jerome Powell for the US federal chairperson, he said it was very, very unlikely. So he used two very words, okay, very, very unlikely, that it will lead to this kind of hyperinflation. But for me, I think that it is likely, but then, but we are still far from there. We need to monitor for the next few months what will be the inflation rate for the US, because why? This will definitely affect the interest rate, okay? And we need to know and understand that the interest rate policy, okay, interest rate policy is actually it's the inflation targeting policy, inflation targeting, okay? So most of the central bank, they will have to use the interest rate policy as in terms of looking at the inflation rate closely. So that means they are targeting at the inflation rate and then adjust the interest rate such that it will reflect with the inflation rate. So my concern here is, although we just had 2 months of interest rate spike, okay, it may not cause any concern, but my worry is the money supply. Okay, we are looking at a lot of stimulus package that pump in, especially in the US, printing a lot of money, and then the stimulus package, and then you can see that money supply is increased, and that causes demand pull inflation and the stock market price increase in the US. And not only that, we also see the oil price started to creep up as well. So now it's above 70 US dollar per barrel. So what we are looking at is that if the inflation rate is consistently at above 4%, 5% for about 6 months time, or more than 6 months time, then the central bank or Bank Negara will actually be forced to raise the interest rate. Okay, so that is my worry. But although now we are still far from there, but it could lead to that. Okay, provided if we have a demand pull inflation followed by led by the money supply, and then followed by a cost push inflation that caused by the oil prices, we may go into that situation. So because if let's say the inflation is above 5% for quite some time, and then the OPR is staying below 2% or 1.75 for a long, long time. So how would you think the, the people that they will feel? They will definitely feel that the money putting in the bank is actually reducing their purchasing power because you can't keep up with the inflation rate. So then the central bank will have to increase the interest rate. Now, what level of interest rate you think it's, comfortable? To me, I would think that if let's say the interest rate not more than 2.5%, okay, 2.5% compared to 5%, there's still like a 2.5% of a change. So as long as it is around 2.5 or below 3%, that kind of a level of an increase, I would think that is still acceptable, because after all, we came from 3% not too long ago. So if we increase to about 2.5 to 3%, it is still acceptable. But anything above that 3%, I think it will, especially in a recessionary kind of environment, it will definitely hurt the economy. Okay, so that is the environment, the investing environment now. Okay, we are looking at the inflation rate, we are looking at the unemployment rate. Okay, and during the 70s here, the US unemployment rate was about 12%, and then they also have this is inflation rate about 12%, and their unemployment rate was also very high. So this high unemployment rate and high inflation rate, we also call it the stagflation. Okay, so stagflation is equal to high inflation rate plus high unemployment rate. Okay, so this is the worst form of economic situation. That means that a lot of people are out of job, and at the same time, they cannot afford the food. The cost of living is too high. So that is called stagflation. Currently, we are in a recessionary situation whereby the price is supposed to be low, and then we have a recession. Okay, so we haven't reached that stage yet, so it's still okay. So we are still surviving, okay, barely, but hopefully with all the stimulus package coming in, and then that will revive. And the most important is what was the root cause? What was the root cause you think causing the unemployment rate? The root cause is the lockdown, okay? Because of the closure of the economy, because of the lockdown, then a lot of people out of job. Demand is shrinking, yes. And if you just, for example, you just go one round, okay, on the street for that 1 month of a lockdown, many shops are closed down, okay? So that is because they cannot survive. So if let's say, and this lockdown, can it be reversed? Yes. So what is the urgent need here? The urgent need is actually the vaccination. Yeah, vaccine, correct. So therefore it brings down to the root cause. The root cause is vaccination. So we must have the vaccination fast enough so that the economy can reopen. So even though with the vaccination, you see in the UK, their population is about 50% of people vaccinated. But look at the COVID cases, 20 over 1,000 of COVID cases. So what does that tell you? That means that even if you have the vaccination, the COVID cases can still be high. It's just that the death rate is very low. Okay, so for UK, the death rate is about maybe 10 or less than 20 people die on a daily basis. So you have 20,000 kind of cases, but then very few people die, and that is because vaccination does help to save lives. Okay, so definitely we need to do vaccination, and the economy need to open. Okay, so that is the more important thing, so that we can get back to business reopening, and then hire more people, and then to keep the employment more. Okay, so that is the most important. So the reason why I want to say that is because all these reflect what you see in the stock market today. You saw that our KLCI index has actually dropped below 1540 today, and that is because the news all reflected in the stock market. Like they have seen the future, they expect what is going to happen in the future, and then they discount back to the present. So whatever you see in the stock market is actually a reflection of what we're going to see in the future. So all these economic data may not be on time enough, but the stock market in fact has already showed you what is going to happen. So you can see that this unemployment rate will definitely be on the high side, and then our GDP will be rather low. Okay, so all those some nice figure that you see in April, maybe it is only for April, because April was opening up, that month was opening up. And then come to this May, June, July, okay, when we are in lockdown. So when we are looking at June and July, so the data will be out in August, September. So it will be a few months later, but already it will be, reflected now. Okay. So, okay, let's continue. Yeah, definitely the stock market is a very speculative place, but it does act as a leading economic indicator. Okay, the stock market is a leading indicator. So the next one, we look at the purchasing managers index. Now, this one is also a very much leading indicator, because this is looking at the production. When we are what drives the manager to buy more material? Okay, so usually if let's say you are the purchasing manager, you need to buy material for your company production purpose, right? You need to receive the order. After receive the order, then you produce things, right? Okay, so if let's say the purchasing manager see that the order is reducing, so then of course you will buy less thing. Okay, so therefore this reflection of the purchasing manager index. And in this case, the purchasing manager index has to be above 50, then it's expansion, and if it's below 50, then it is contraction. So I can let you see that these are the trend for the UK PMI until April this year, May. So it's after the bottom here, it is rising. So the US PMI is also rising. Malaysia PMI, we dropped until here, but then for the last few months, it was rising. And the next week, we're going to announce the PMI. It should be above 50 as well, because we are looking at the April and the May figure, okay? And then the Singapore PMI is above the 50, and then the Indonesia PMI is also above 50. So we are looking at up till April and May, all these PMI figures are improving, okay? So that means we probably were getting out from the lowest point here, and then we should be looking at economic recovery. Okay, we should be looking at the economic recovery. So all these figures here you can find from the in tradingeconomic.com, which is the website that I show you. Okay, yes, thank you. So it's below the 50 is contraction. Okay, so I put here below 50. Okay, if it's below the 50, then it is contraction. Okay, then if it's above 50, then it is expansion. Okay, above 50, then it's equal to expansion. Okay, so we should be looking at economic recovery. Of course, the lockdown month is June, so we still need to see the June figure and then the July figure, and then so that we can see. So this will be about 1 month or 2 months later. Okay, but what we are seeing here is that it's a recovery here. Now, another leading indicator that I want to show you is this one is called the yield spread. Now, yield spread is looking at two treasury notes. Okay, two treasury notes. You're looking at the 2-year note and a 10-year note bond. So 2-year bond and a 10-year bond. So particularly this one is the US treasury note. And in the past, they have seen this interesting scenario. Whenever you have okay, first I explain what is this 2-year note. 2-year note meaning that your treasury bond is 2 year of a tenure. Okay, so that means the maturity date is 2 years time. And then 10-year note means that maturity time is about 10 years. So you're looking at 2-year and 10-year, and they are different. So usually in a normal economic condition, the interest rate, the longer years interest rate is supposed to be higher than the shorter years, okay? Because it is higher, because it is longer, so you need to compensate with a higher yield, so you need to pay higher interest rate. And it also indication of an economy, a healthy economy, you should be looking at rising interest rate in the long run, okay? Because of the inflation. Inflation increase, then interest rate also increase in the long run. So that is supposed to be the situation. But what we see is that sometimes the long-term interest rate or the long-term yield note can be falling. Okay, so that means you will be seeing that inverted yield curve. The yield curve supposed to be forward-looking. That means it's upward sloping. Okay, because as you go along, the longer the years, that means the inflation and then the interest rate is supposed to be increasing. But sometimes you will see that the interest rate is not increasing, but then it's revert. That means the longer term yield is inverted. It's called inverted yield. So when did that happen? So if you to look at it, we use a 2-year minus a 10-year. Usually it's supposed to be positive. 10-year minus a 2 years usually supposed to be positive. But if let's say you see that 10-year minus a 2-year is a negative, okay, especially in this manner here, 07, 06 was negative. And then when was the financial crisis? The financial crisis was 08. Okay. And then you saw that in 2019 also became negative. And when was the the pandemic? It happened in 2020. So do you see that this is actually some form of a it gives you some predictability, prediction about the stock market, the US stock market. It tells you that whenever you see that the spread between the 2-year and the 10-year is going towards zero or negative, within 2 years time, you'll see the stock market crash. And then same thing here, 2019, you see that this towards zero. Then in 2020, we saw the stock market crash. Okay, so this one is a leading indicator whereby we look at the yield spread. And this one is the current situation. So currently the yield spread, this one you can Google, you can find the information from many sources. You just Google yield spread US 2-year/10-year yield spread, and then you can get the information. So this one is the latest information whereby it is around 1.3. It's a positive figure because we just had almost zero here. So then it is 1.3 now. Okay. Okay. So there's also another indicator. We call it the Shiller PE Ratio. It's called the cyclically adjusted PE ratio. Shiller is a Nobel Prize winner. He's a professor for a very famous university. I forgot which university, but very famous one and Nobel Prize winner. So this indicator is actually developed by him. So we can actually saw, you can Google Shiller's Cape and then you can saw the latest indicator. Yale University, yes. Okay, thank you. Thank you, Li Gun. Okay, so it's a Yale University. So interestingly, you can see that whenever it spike, okay, there's a spike. Okay, so now currently it is 37.7. This is the latest figure. Okay, you Google, then you can see that it's the latest figure, 37.7. And when was the last time where we had such a high figure? So if you can see, it was the 2000.com bubble. Okay, that was the time. And then those were the, the Black Tuesday, all these were the, much further away. We just look at the most recent one. The most recent one was the .com bubble over here. So that means what? That means currently what it shows you that the US stock market is overvalued now. Okay. Yeah. Okay. Yes, Sharudin, yes, correct. It's a battle between history will always repeat itself, and it's different this time. Okay. So yeah, you're right. Okay. So whenever we look at the history, we tend to see that whether the history will repeat itself, and then if it repeats itself, that means it fulfills this technical analysis. That means history always repeat itself, and then sometimes there will be exception as well. Okay, because we can't guarantee all the time, so sometimes it will be exception. So then there will be exception in certain cases, but what we are looking at is that majority sometimes it is repeating. Okay, so actually when you're looking at the PE ratio, you definitely have to Google, and then you can see most of the technology stock, they are maybe on a high region, and then but at least from here, the PE ratio here you're looking at is actually on the high side. Okay, and recently I also read an article, okay, about Warren Buffett. Warren Buffett recently also sell a lot of his stock, and then he's like try to keep like a cash position because he find that there's no more value. All the stocks in the US are mostly overvalued. Okay, do you think that another crash is on the horizon as the market worldwide overpriced? I wouldn't say that it's like a market crash, but what I see is a 10 to 15% of a correction in the US market. Okay, so 10 to 15% of correction. I would think that it's a correction because if you are looking at the crash, last year was the crash. Okay, so the crash doesn't happen too often, so it will be a correction this time, and it is like a 10 to 15 kind of a correction. So it will still be a healthy kind of a correction because we should be looking at economic recovery. Okay, not like going into another further down. Okay, should not be. By right lah, if I'm looking at from the past history and then what is happening now, it should be recovery. Okay. Will the Shiller ratio will climb higher than 45? Yeah, why not? I mean, if let's say the US stock market keep rising and rising, now they are historical high, okay? And then if let's say they keep rising and rising, but I have to tell you that usually July is not a crash month. If you're looking for a stock market correction, right? July usually it's I hardly see any crash on July. What is more probable is August. Okay, August will be a month whereby it's more easily having a stock market crash. Another month will be the November, October or November. Okay, so these 2 months will be more on volatility. Okay, so if you are waiting for this kind of a correction, okay, you definitely have to wait a bit longer. Okay, will be 2 months later or 3 months later. Okay, does the reverse repo between the Fed and the banks might be in an issue for the equity bond market? Okay, so I would think that if let's say you're looking at the repo market, because repo market will be the short-term rates, and it looking at the lending between the banks. So if let's say the banks are full of liquidity, so I wouldn't see that there's much of a problem, because you are looking at the interest rate at a low rate environment, and then the repo rate is not like increasing a lot. So I wouldn't see that is, you know, too much of a problem. Okay, so okay, then next we look into other indicators, some lagging indicators. So CPI inflation rate is a lagging indicator, although it is a monthly indicator, but then it is after the incident. Okay, after 1 month, then you publish the result. So sometimes the result not on time, then it will be a bit late. So CPI can be a lagging indicator, but it does tell you about the price trend. Okay, and then the GDP figure is even lagging because it is 3 months. So if let's say you are looking for June, the second quarter June, the figure will not out until August. Okay, so that will be some lagging there. And then the unemployment rate, if let's say you're looking for the US unemployment rate, that will be very on a weekly basis. The unemployment benefit, the claiming of the unemployment benefit is on a weekly basis, weekly claim rate. So that one is weekly. So that one is more on the coincident indicator, and then more on a leading indicator. However, if let's say you're looking for the Malaysia one, which is on a 1 month basis, but then on a 1 month basis, sometimes you can delay to 1 month to 2 months. So that is kind of like a lagging, but but unemployment rate does give you a future outlook about what the employment market, because this unemployment rate is actually forward looking, because you are actually looking at the economy. If let's say economy is doing well, you will hire more people. If your business is good, expanding, then you will definitely hire more people. So this unemployment rate, the concept is forward looking, but the data itself can be lagging. Okay, the data itself can be lagging. And also the corporate earnings. The corporate earnings is also looking at some lagging indicators, because it's like quarterly report. So it is kind of like, you know, 3 months later, and 3 months later you then look at the figure. So you'll be lagging. And then retail sales are actually also lagging, because you are looking at what was happening last month. Okay, so this is also lagging. But then all these figures, it does give you an idea about the economy. And exports data is also lagging, because it is on a monthly basis, but it is like a last month's data. But nevertheless, it does give you an idea what is the important driver for the economy, especially in Malaysia. And a lot of people ask me, okay, so what are the catalysts of the economy? Because looking at what we are seeing at the moment, what are the catalysts of the economy? So I've been thinking this, and then I think the only catalyst now is the exports market. Okay, so you really have to look at the exports market, which are the companies that they can export to the foreign markets. Because you see, Malaysia is locked down doesn't mean other countries are locked down. We see Singapore not locked down, China not locked down, US not locked down, and these are our three major exports partner for Malaysia. So if our major partners are not locking, I mean, they do not have a lockdown and then they are still doing well. So if we can export to this country, so that means it can drive our economy. And another sectors that I can think of is probably the commodities and the agriculture. If we're looking for all these, recently I saw that the mining figure also increased for Malaysia. So these are the commodities, because currently crude oil price started to creep up a little bit. Crude palm oil, although the price dropped, but then it's still above 3,000 level. The problem with the plantation sector is because of the labor workers. You do not have that kind of a labor to do the harvesting for you. So you can't have that, you know, the production there. So that's why a lot of plantations stock, they come down. Although the price is there, 3,000 and above, but then you know, they have a internal problem, the workers problem, due to the lockdown and also the pandemic. So all these factors are affecting the industries and different industries in the Bursa Malaysia stock. So when people ask me, where do we find the catalyst for the Bursa Malaysia? So I think the exports market will be the better bet. Okay, and so that means what? That means the technology stocks that export, like chips and all those semiconductors company where they still do exports, maybe they are still okay. Okay, industrial, yeah, provided their operation is not affected by the MCO. Okay, if let's say their operation is, it's 50% less production, so that may be a concern as well. Okay, so that is why I think the most important thing that we need to get is the vaccination. Okay. So this is the initial jobless claim for the US, is on a weekly basis. So as you can see, as long as it is on a declining trend, it is good for the US. That means that this initial jobless claim is like our SOCSO claim. So you know, our SOCSO claim, you can claim for the unemployment benefit, right? So if let's say there are more people claim the SOCSO, so that means a lot of people are out of job. So it's no good. So then we should see the jobless claim should be reducing, then economy is good, doing well. Gold price is an interesting commodity because it will go up when the market is in trouble. Okay, so the gold price will go up is when the stock market is in trouble. So if let's say the stock market is doing well and then, you know, recovery, so the gold price, there is not much of a catalyst unless you're looking for a war. If there's a war, then the gold price will go up again. So this gold is actually more like a diversification in your portfolio. Okay, you shouldn't put too much money in the gold, but more like a diversification. So just in case your stock market didn't do well, at least you have the gold price to support in the portfolio. Okay, okay. So this one is the Malaysia unemployment rate, and that I've shown you. Okay, and you can see that 1999 April it was 4.5. And then quickly it has had a reverse. Okay, so in the history of our unemployment rate, we always maintain at a 3.3%, 3%, 3.3, so 2.7. So it's always that 3% level. So actually in the past, the unemployment rate to many economists, it was very boring data, until recently I saw that you know, some concern over here. Then you can see that 2009 February, it shot up to 4.1. Okay, but after that, it came down quickly. Within 2 months, it came down below 4, and then it down to 3.2. So that means this recession was not, you know, something that concerned us so much. And the stock market had a V-shaped recovery, okay, during that time. Then this one is a 2020. So what is worry is that this 2020 level, it has been about a year now, we are stuck in the 4.5% and above level. So that is a concern. Okay, so which means that this recession, it is worse than what we expect. If you were to look at the previous two recession, we probably would think that, oh no, it will be like a quick one, then we recover within 2 years time. But if you were to look at this unemployment rate, so I'm afraid this recession will be something, beyond our expectation. Okay. But luckily we have the subsidies. So the government subsidies is a major great benefit in the economy. Okay, that will definitely help the consumption. Okay, so now here I'm going to show you some Excel worksheet. So how I draw the MA line. Okay, so this one is the Excel worksheet. I have done GDP and unemployment rate. So what I did is that I wanted to export the tradingeconomic.com data. And then when I export, it says that I have to pay. It's a subscription thing. Okay, so I didn't subscribe it. So I copied the number one by one. So that if you want to do that, you can copy the number as well. So this row here is on a quarterly basis, Q3, Q4, and then Q1, 2, 3, 4, Q1, 2, 3, 4. So it's on a year-by-year basis. So all these numbers. So this is the GDP figure. Okay, so GDP figure, one row, you can have all these figure until 2021 first quarter. The second quarter is not out yet. So until the first quarter. So this is the most recent GDP figure here. And then the next part over here, it's a moving average. Okay, MA line. So this is a 3-day moving average. Okay, three quarter moving average, because we are looking at quarter. Okay, so it's a 3-quarter moving average. So we are looking at average, okay, of these 3 days. So it will be equal to average of 1, 2, 3, 3 days, 3 quarters of this average. Okay, so if you to put in the Excel worksheet, it will be equal to average, and then open bracket, and then you highlight the 3 figure here, and then you close bracket, and then you enter. Okay, so that's how I do this MA equal to 3, and then you can do this. Okay, so you just drag it down, and then all this will be the moving average line equal to 3. Okay, so after that, you plot it over here. You construct it over here. So you highlight this figure. Okay, you highlight this figure, and then you go to insert chart. Okay, insert chart, and then you can see the chart. Okay, here is the chart. Okay, so these are the chart. So you can choose this chart, and you can plot this. Okay, so I will bring it out over here. Because if I were to bring it like 5 or 6, it will be too long. Because we want the quarter itself is already very long. Okay, 1 quarter is equivalent to 3 months. So if let's say I use 4 or 5, and then you can see that the line is almost like flat. Okay, it's not really like showing something. So then I have to show 3. If it's 2, then it is too short. So after looking at the figures, I find that 3 is more easy to tell you the signal. Okay, so this orange line will be the signal line. Okay, which is this MA line. Okay, the orange line will be the MA line, whereas the blue color will be the GDP figure. So if you to look at this orange line, so when the price, which is the GDP price, when the price above the orange line, it means that it is bullish. Okay, so that means it is improving. So there's a improvement in the economy. So you can see that this is an improvement, and then there's a drop here, improve. So over here, when you see a lot of cross here, meaning that basically the economy is on a kind of like a horizontal trend. That means the economy was giving 5, 4, 5, 4, 6, this kind of range bound figures that you are seeing. Okay, so all these are in a stable economy situation. So in a stable economy, you can see that the moving average line is kind of like horizontal. Okay, then this line is actually good for when you see a crisis. Okay, when you see a crisis, then you see that, okay, now this blue color line is like below this orange for quite some time. You see, for the 2014, the last quarter, after the last quarter 2014, it was below the orange line. And then after that, it was kept below the orange line for quite some time. So that means for the economy, it was the whole year of 2015, it was a down year. So if you to look at the stock market, we will see that 2015 whole year was actually down as well. So that means this GDP figure is actually very close relationship with the stock market. It tells you what the stock market is behaving. Okay. And so because these are all very long years, so that means I separate into 5 year, 5 year. I look at the situation into 5 years, 5 years. And then this one is the stock market. So 2015, you see that 2015, in fact, was actually a down year. Okay, so this is 2016. Okay, so just now we saw that the 2014 last quarter, the line crossed. So that means beginning of the 2015, in fact, the GDP there already showing me some weakness in the GDP, the economy. But over here, we only see this in April. Okay, of course, there's some lag over there. Okay, because this fourth quarter, the result only came in February of 2015. So February of 2015 will be here. Okay, which is around here. So still, you see the price go up further to April, and then after that, then it come down. So and it was a whole year down for the 2015. Okay, so then we take a look at the rest are very much horizontal, because you can see that 2016, 2017, until 2018, our GDP is always 5, 6, 5, 6, 5, 6. You see, it's not much of a changes here. It's more horizontal, and 4 and 5, 4 and 5. Okay, 4 and 5, and it's more like a horizontal. Okay, keep on having, you know, similar kind of numbers that you see. That means that the economic growth was in like a horizontal state. So therefore, the lines are all horizontal. Okay, so 2016 until the 18, the lines are all horizontal. Until you see this 2019 onwards, the third quarter, then the line started to expand. And then the fourth quarter also expand, and then until this 2020 first quarter, that's the worst that you can see. Okay, so then look at the stock market. So 2019 was here. Okay, so over here we see that the 2019, the fourth quarter onwards, the third quarter and the fourth quarters onwards. So 2019 October was the third quarter. So after the third quarter, you see that it was actually top over here in January 2020. Then after that, then you see this sharp fall. Okay, so in fact, this what we saw in the GDP is very much reflection of what we see in the stock market. Okay, it is actually a instantly reflection of the stock market, instantly. Okay, so then over here we see that there's a cross and the third quarter of our GDP chart here. So let's see the quarter of our GDP 2020. There is our stock market actually recover. In fact, if you to notice the stock market in the last quarter, which is November, there were a lot of breakout for all the sectors. Across all the sectors, there were a lot of breakout. So which also confirm this trend. Okay, the third quarter and the fourth quarter, it was in the stock market, it was actually doing quite well. Okay, for Malaysia. And then, okay. So now you are looking at this converging. Okay, so converging means what? It means that we want to see whether this the next quarter, we want to see whether this blue line will cross below the 20, this orange line. So if it cross below, that means the economy is going to go down again, and then the stock market will go down again. So the next figure will be the second quarter. The second quarter figure will be only out in August time. So that means by August, I'll be able to fill in one more data here. Okay, I'll be able to fill in one more data here, the second quarter, one more data, so that I can calculate the rate of change here. Okay. So then I can see whether they will be, converging, or is it like further away. So if it's like further away, that is good. But if it's converging, that means it's not a good sign. Okay, so this one we need to monitor further. Okay, so that was our first quarter minus 0.5. So we want to see second quarter. Second quarter is supposed to be better figure, because second quarter we have the April, as the April and May we had the economy was reopened in April and May. So then we should be able to see some positive figures here for the second quarter of GDP. And what we will not see some good figure will be the third quarter. The third quarter of the GDP, because the third quarter will be in July, August, September. Okay, so unless we have an economy reopening and then the cases all come down, then we will have some favorable. But the second quarter, we only have 1 month of a lockdown, which is in June. So probably this figure will not be as bad lah. It will not be that bad. Maybe it's positive of 1.5 or something. Okay, maybe we have around that figure. Okay, so that means we should be anticipating the GDP figure rather than looking at that GDP figure. So what I was doing just now, I was trying to guess what could be the next quarter figure. I was trying to guess, looking at what is happening, I was trying to guess. Okay, so we should be anticipating, so that we can anticipate what is going to happen in the stock market. Okay, so this one is the GDP figure. So the next one I want to show is the unemployment rate. Okay, as I told you, unemployment rate for the past 20 years, it has been very boring. 3.4, 3.5, 3.4, 3.5. So when I key in, I also find it very boring, because these numbers are repeating over and over again. Okay, until I saw this number 5.3, 4.9, 4.7. So these are unusual, very, very unusual number. Okay, in our history, that means we have a high unemployment rate. And so same thing, I do a 3 and MA line equal to 3. Okay, 3/4, MA line equal to 3, and then I calculate. Okay, so I just drag it down. Okay, so I have a space here. Okay, so then because I want to separate the chart, so that's why I have a space here. So I'm doing the chart like maybe 6 years of a time frame, so that I do not crowd every data together, so that I can see things in a better scenario. Okay, so let's see. So in this case, we saw that this unemployment rate will be how we look at it is opposite of the GDP. So that means what? That means this unemployment rate, we want to see the figure going down. Just now, the GDP figure, we saw the figure going up is good. Okay, so for unemployment rate, we want to see that the figure going down is good. Okay, so if the figure going down, that means economic improvement. So if we see the figure going up, that is not good. That means high unemployment. So we want to see the figure going down. Okay, so this is a 2000 level, whereby we saw the high unemployment rate, but it was only for like a few months, and then it come down again. Okay, so it wasn't like very persistently high unemployment. So we can see that unemployment rate was only like a few months and then it come down. So it doesn't cause much of a concern, okay, if you to look at the history of our unemployment rate. So over here, what we see is that we have more months of good months, okay. So this is 2005 to 2006, more of a good months here, and which means the economy recovery over here. And let's see, okay. So the next one is the 2011 onwards. 2011 onwards, okay. So 2011 onwards, all the figures are very boring, 3%, 3% level. You see, it's always on the 3% level. So then this line is also like horizontal, because it just shows that this trend is same trend, okay. So for this 2010 until 2013, the trend is the same until here, the 2013 onwards. 2013 onwards, you see that the trend is actually going down for quite a significant time, all the way until 2014. Okay, the whole year of 2014, it was the unemployment rate was very low, almost like 2.6, 2.7 here. So that means what? That means these were the good times whereby the economy created a lot of jobs. Okay, and with the 2014, the stock market was actually doing well as well. So we can see from here, the stock market 2014. Start from 2015. Oh, I didn't print screen the 2014. Okay, but anyway, okay. So let's look at the 2015 job data. Okay, so from 2015 onwards, you can see that the unemployment rate is always on the 3.3 level, 3.3, 3.5, 3.3, 3.5. Okay, so it is always horizontal. So that means from 2015 until 2019, right? In terms of the job employment, not much of a problem for Malaysia. Okay, until 2020 onwards. So this is 2020 January onwards. Then you see a spike over here. Okay, so for quite some time, it was above that level until July. Then it crossed down. After it crossed down, and then it crossed up again. Then now it is crossing down. Okay, so by this, looking at this, we should be looking at economic recovery, because the blue color line is actually below the orange color. Okay, so that means that the unemployment rate actually come down. The rate of unemployment rate actually come down, but still it is maintaining at above the 4.5% level. Okay, so which reflect on our stock market. Our stock market, in fact, did improve. Okay, the second half of the year, it did improve, but then until 2 months ago, our stock market actually, in fact, from January onwards, our stock market actually was horizontal for quite some time, for about six months. From January until June, our stock market was horizontal. Until these few days, there was actually a breakdown. Okay, that means our stock market index was actually below the 200-day moving average for 5 days. Today is maybe the 5th days or the 6th days. Okay, so that is happening to our KLCI index. That means we are below the 200-day moving average for the stock market. Okay, so this is how you can apply this moving average line into other indicators as well. So you can apply into inflation rate, and then you can apply into other indicators. So all these indicators you can find from the tradingeconomic.com. So the reason why I choose the GDP and the unemployment rate, because the unemployment rate tells you about the job market, which tells you about the confidence level of the economy, okay, whether people are hiring or not. Whereas the GDP figure is the actual situation. Okay, so that's why I use these two figures. if you want to use the interest rate, I mean the inflation rate, probably you want to forecast what is going to happen to the interest rate, then probably you use inflation rate. Okay, so but for the stock market, I think these two are good. Okay, and then if let's say you want to use the PMI also can, but I think I didn't do the PMI. Okay, so I just do the GDP and unemployment. Okay, so then go back to the slides. I just have one more slide, okay? Just bear with me, one more slide. I'm going to look at our GDP figure, whereby we look at for the last 50 years, this was our GDP figure. And this GDP figure, we can actually see that there were not many occurrences whereby our annual GDP figure was below 0. Okay, so when the annual GDP figure below 0, it means negative. So there were not many occurrences that actually we had a negative GDP in the history. So the last time that we had a negative was -1. This was the 80s, okay, 85, 86. Then there was 1998 financial crisis -7.4. And then 2008 -1.5, and then the next one was last year, 2020, also a negative figure here. So there were not many times, but then what does that tell you? It means that whenever you have a negative, it means a severe recession. It's a major recession. Okay, whenever you have a negative in a GDP, it means a major recession. So it means what? It means these are the golden opportunities to buy into the stock market. Okay, so I have to say something like that because I understand everybody is very bearish now, but I have to tell you this figure so that you know that actually we are in a recession. It's a golden opportunity for you to buy the stocks now. Okay, maybe you don't have to buy in like one shot in 1 month. You just have to spread it out in July, August, September, October until the year end, or even until the mid of next year. You spread it out about your investing, and then you just accumulate whenever you have extra money. All these you have to invest with extra money. Okay, so whenever you have extra money, you try to save. So that means now you don't think about spending, so you delay your spending. Okay, you delay your spending behavior, and then you try to save the money and then put it into the stock market, invest, because these were the golden opportunity. So if you to look at the 1986, it was a big drop here. And then there was also the 1998, it was a big drop here. And then the 2008, also big drop here. So what you are seeing is that these were the golden opportunity for you to buy into the stock market. Okay, although for this round, we wouldn't see like a overnight of a rebound. Okay, it could be a 2 years time. So I'm looking at 2023. So if you to buy now, 2021, you don't sell until 2023, I'm sure your portfolio will be much better than what you see now. Okay, so we have to see things in a macro perspective. So that is why we need to look at the economic indicator. So the economic statistics or indicators, it will tell us a macro view. Okay, because when we are in the midst of it, we are in the recession, we feel very fearful, and then we feel very miserable, especially when you look at the social media and then you see all the sad story. But you have to look beyond that. Okay, that is part of the recession. So we have to see things from a bigger point of view, that we are in the recession, and these are the time whereby the stock price will be low. Okay, we are in a low cycle session here. So that means that we should be looking at buying rather than selling. Okay, you just have to buy stocks that are in the different sectors, because you want to diversify. You don't put all the eggs in one basket. You look at different sectors. You can have consumer sectors, you can have technology, you can have utilities, you can have healthcare and industrial. And industrial is quite a good sector that you accumulate at the moment, because although our economy is locked down, but then those foreign markets, they are not locked down. So this industrial company, they may be producing for export purpose. So they are making money. So you have to identify those sectors, and then among the sectors, you choose the best stocks, and then you just accumulate over the years, okay, over 1 year. Give yourself 1 year to accumulate. From 2021 until 2022, you give yourself 1 year to accumulate. So I'm sure by 2023, 2024, you see your portfolio, it will be a much higher figure than what you are going to see now. Okay, so that will be the end of the session here. So any question?
Yes, if you have any question to ask Pauline, you may write in the question and
See
answer.
a lot of questions. Okay. Shall I look at the Q&A or look at the chat? Because there are two
Okay,
places.
I will address the Q&A for you, lah. Huh? I will
Ah.
ask you the question now. The first question is, what is the money supply leading indicator like M1, M2, M3, and how does it relate to the share market?
Okay, so this is a definition. Okay, so we start with the M0. The M0 will be the actual notes and coins, the actual money lah. Then we go on to the M1. And as you are moving from M1 to M2 to M3, you include more categories, so include more. So when the most common one is the M2 include the physical notes and coins, and then it include the savings account, include the checking account, and then credit facilities as well. So that will be the M2. And this M2 will be usually what the economists usually look at, because this is the actual money supply that everybody is using. Okay, then of course you have the M3 and M4, and that will be a bigger classification. That means you include more and more category inside the money supply. So the indication to the stock market is that because of this liquidity, usually when you have all this liquidity, right, where will the money go to? The money will go to the FD, the money will go to investment, and then they will go to the properties market, into the asset. People will find their ways to invest. So therefore, it will go to the stock market, the assets, and it will make the share price increase. Okay, so that will be the rationale between the money supply. If you see money supply increase, by theory, you should be seeing the asset prices increase as well. At least this is what I saw in the US market. The US market is in a historical high level, and then their property prices are also rising. And then I also see that in Singapore as well. The property prices are also rising. But maybe in Malaysia, we are still in a recession situation. So we don't see much of that happening. Okay.
Okay. The next question is asked by CW. May I know what is the correlation between bond yield, interest rate, and gold price?
Okay. So the bond yield and the interest rate, they are related directly, because the interest rate will definitely affect the bond yield. And this bond yield are referring to the yield to maturity. So a lot of people, they confuse the coupon rate and the bond yield, and which is the yield to maturity. So coupon rate is like a fixed rate for you. For example, this 10-year bond give you a 10% of a coupon rate that is fixed. Okay, so it doesn't really matter. But what is mattering is the bond yield, which is the interest rate, and we also call it the discount rate. And this is this discount rate that will affect the valuation of the bond price. And the relationship is inverse relationship. So if let's say the bond yield is low, then the valuation of the bond price will high. Okay, so it's an inverse relationship. So if we are looking for the bond yield is lowering, then the valuation should be raising. Okay, and then vice versa. And then for the gold price is because usually for the gold price there are many factors, and one of the factor is the US dollar. So if let's say you're looking for the interest rate to increase, most likely the US dollar will also increase. So when US dollar increase, then the gold price will come down. Okay, so that is that relationship. So interest rate increase, US dollar increase, and then when US dollar increase, gold price drop, and vice versa. Okay.
Okay. Now, just now you use simple moving average 3 as an indicator. So there's a participant who want to ask like, why you use 3 when you plot the graph? Is there any reason?
Yeah, just now I would also explain in the session, somebody asked in the chat also. So because I tried to use 5 and then 6, but then it was like a straight line, not much of a signal to me. So because the quarterly figure is already 3 months, and then so if let's say I use too many quarters, then it will be like it's not a reflection. It's not like having any signals at all. So then that's why I use 3. And then if let's say I use 2, also not very, it's too short. So that's why I use 3. Okay.
Okay. Now the next question is asked by Shahiru Iksana. So how does the Malaysian government debt deficit affect the economy in the long run?
Okay. Now, in 1998, there was this financial crisis, and one of the excuse whereby the hedge fund manager, they short sell our currency was because they claim that all these emerging countries like the Philippines, Malaysia, Indonesia, and Thailand, all of these countries, we have a twin deficit. The twin deficit as in a budget account deficit and also your current account deficit. So just now you're measuring the budget account deficit, is it? Is it the budget account deficit? Yeah. So that means that we are looking at our
Debt deficit.
debt deficit. You mean I would think that it's more like a budget account deficit. Okay. So that means the government is actually spending more than what we are receiving. So then we have when you're spending more than what we're receiving, actually we'll borrow more money. So then it will raise the debt of the government, and of course the budget deficit also balloon. So there's an indicator of not more than 5%. If let's say you're looking for budget deficit. So if let's say your budget deficit is more than 5%, or your current account deficit is more than 5%, people or these fund manager, hedge fund manager, they will have see that there's a weakness in your economy. And even if let's say you're looking for debt also, if let's say the public debt is also on the high side, then there's a weakness in your economy, and then they will see that your currency is on the weak side, and then they have the excuse to short sell your currency. Okay, so that was happening in the 1998. So now what we are looking at is that for any economy, not only in Malaysia, as long as any country whereby they have a huge debt, okay, and then their credit rating will be have a low credit rating, and then their currency will be weakened. So most likely you will be seeing your country currency depreciating. Okay, if let's say you have a huge debt. Okay, so that will be the consequence, depreciation of the ringgit. Okay.
Okay. The next question is by Ahmad Hifzuddin. So when FOMC announced that interest rate increase in bond and US dollar will result down in stock, commodity, gold, futures, property, and crypto market because money flow will focus on US dollar and bond. Is it true?
Okay. This question is very similar to just now the question asking about the interest rate and the US dollar and the gold price, because commodity is something like a gold price. So what we are looking at is, let's say you raise the interest rate, then the dollar value will increase. So when dollar value increase, the commodities will drop. Okay, because the commodity is denoted in USD. So when the US dollar increase, then the price will drop. So cryptocurrency is a commodity-like currency. So therefore, cryptocurrency will also be falling as well if US dollar strengthening. Okay, and I hope that answered your question.
All right. So I guess that will conclude our question and answer for today. So thank you so much. So let me share with you where is our next webinar. Just give me a minute. All right. So before we talk about the next webinar, let's talk about Bursa Academy. All right. So as usual, Bursa Academy is a one-stop e-learning platform that contains a lot of information, a lot of investing resources for you to learn about investing articles. You can read from investing articles, investing webinars, video recording as well. Just head over to www.bursaacademy.bursamarketplace.com. For our next webinar, it will be happening on this Friday, and the topic is Bina Trading Berjaya menggunakan isyarat chart pattern. So how do you build your trading career using chart pattern signal? All right, so this is happening on 2nd July 2021. It's a Friday, 8:30 to 10 o'clock. So I given you the registration link in the chat box and also in the YouTube live chat. So can go ahead to register yourself for our next session if you want to learn more about how to use chart pattern to form your trading plan. Okay, with that, thank you everybody for joining today's session. We have many of you here who are tuning in online on time to learn about how to use economic indicators to time the market. I hope that today you gain enormous value out of it, and also want to thank Pauline for sharing with us a very essential masterclass on economic indicators.
Okay, thank you. Thank you, everyone. Thank you. I see a lot of thank you there. Thank you so much. Thank you.
All
Hope to see
right,
you
so
again.
have a great rest of the day, guys. Okay, take care and bye bye.
Okay, bye-bye. Good
See you
night.
on Friday.
Okay, bye.